Ryan Reynolds here from Mint Mobile. I don't know if you knew this, but anyone can get the same premium wireless for $15 a month plan that I've been enjoying. It's not just for celebrities. So do like I did and have one of your assistants switch you to Mint Mobile today. I'm told it's super easy to do at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Reality radio for a really great future. We're talking real money.
Hello again. It's a new week. I'm Don McDonald. Welcome to Talking Real Money, the daily version. Glad you listened in. I really appreciate all of you downloading and listening to the podcast, and I would hope that you like it enough to tell friends, acquaintances, family members, and more. And remember, you can always call in your questions, too, to the podcast 24 hours a day, 7 days a week at 855-935-TALK, 855-935-8255. Okay? Oh, by the way, when you call, make sure you've got a really good connection or a good phone. If not, try to call again. Every once in a while we get a connection that's just really bad and it's hard to hear you. And then it's hard to use the question. So 855-935-8255. And we'll get to the phone call of the day soon. But let's start with the topic of the day. I want to look back at 2018 again because last year was a unique year. Usually when stocks fall in a year, something else goes up. Bonds will be up or something. Even over long periods of time, there's usually an offsetting market. For example, between 2000 and 2010, we had that lost decade. Remember that? Where the Standard & Poor's 500 didn't get out of its own way. It ended up, I think, losing just fractionally over that period. But it's still lost. I'm going from memory. But during that same period, international stocks did relatively well. So if you had a globally diversified portfolio, you didn't suffer a lost decade. You suffered a decade in which you made a little money. But last year, foreign stocks were way down. U.S. stocks were down. Small cap stocks were down. Value stocks were down. Growth stocks were down. Commodities were down. Real estate was down. Even bonds lost money during what was the worst year since 2008. But remember, last year was not anywhere near as bad as 2008. So while every asset class was down in 2018, there was one single type of mutual fund that actually made money. They're called inverse funds. These are mutual funds that instead of owning securities, they borrow securities to sell them without owning them. It's called short selling. We'll talk more about that later in the show. Last year, for example, the RIDEX, and RIDEX has lots of these wacky funds. The RIDEX Inverse S&P Strategy Fund, strategy. It actually sounds like you have a long-term plan to do this. But okay, the RIDEX Inverse S&P Strategy Fund made a little over 4% for its investors. Wow, 4% in a bad year. Well, before you run out and place a buy order, I want you to hear the rest of the story. Over the past 15 years, going back to, let's see, what does that make that? 1994. Over the past 15 years, the fund's been around, and it's lost an average of over 8% per year. Oh. Even though it posted big gains in the early 2000s, a huge gain in 2008 where it made about 40% in a year, and a 4% gain in 2016. If back when this fund started in 1994, you placed, gambled with $10,000 in it 15 years ago, and you said, I'm going to let it ride because I'm afraid of these markets. Remember now, we had a terrible market in the 2000s, the beginning of the 2000s. We had a terrible market in 2008. We had a terrible market in 2016. We also had some downturns in 2011. And so you had some bad markets in there. If you put $10,000 in today, you would be sitting on a nest egg of just under $1,300, $1,300, a loss of almost $9,000 versus if you just put it in the S&P 500, just the S&P 500, and you even suffered that lost decade in there, and 2008 and 2016. You just bought the stupid S&P 500, which we don't suggest you do. After 15 years, that $10,000, despite all those downturns, would have turned into, you ready? $91,000. So, here's the moral of the story. Stocks are painful at times. They are. But overall, they have, and for all intents and purposes, they must, unless the economy of the planet goes to zero, globally diversified stocks. Stocks have and pretty much must go up more than they go down, which makes betting on them going down a fool's bet. Absolutely stupid. Unless you get the timing right, and to get the timing right requires you know the future. Got a question about money, investing particularly? Call us on Talking Real Money Quick, 855-93, Talking Real Money Daily. We changed the name. If you have a question about money or investing, give us a call on our daily podcast, Talking Real Money Daily, 855-935-TALK, 855-935-8255. And today's call is coming up now.
Hello, this is Todd. I've got a question on a 529 college savings program. My daughter is 16. She'll graduate next year, so I'm probably 2 years away from a draw. And right now, all her stocks, mutual funds, are all index funds within her 529 are all exposed to stock, diversified into small, mid cap, large cap, international. Done quite well. And my risk for tolerance, though, I'm okay with the ups and downs. But I'm at a point now where I'm within two years of draw. I'm sure I'll need a little bit of the Vanguard custodian, which we normally go with. And there's really not a lot to choose from when it comes to someone with as high a risk as, and maybe the target funds that are 80-20, which is 80% bonds, 20% stocks, broadly diversified for her age group. I guess I'm okay with that. Just wanted to know if there's another option to choose from other than just picking and choosing those mutual fund or index funds that relatively match that target fund. I can't remember the fund name or number, but I feel if I had to choose, it would be that 80-20 mix of 80% bonds, 20% stocks. But we just wanted to know if there's another option using Vanguard funds. Thank you.
Wow, good for you setting up the 529 for your child. Very smart. You are, though, getting to that point where despite your high level of comfort with risk, you do need to do a little bit of tweaking of the portfolio. You don't want it all to be in very aggressive equities just in case, on the off chance that, say, in 2021, the market suffers a 2008 again, and you lose 30, 40, 50% of your money. That could hurt her education chances. So you're right, you need to do something. Now, do you need to do something as dramatic as the 2080? For most people, the answer is absolutely yeah. That's what I think is the best solution, is to do something like the 2080 target date fund, which I believe is called the Vanguard, get this, 20% stock, 80% bond portfolio, or something really close to that. Yeah, nothing fancy. However, in your case, because you understand risk, maybe you could go as high as 40% stock, 60% bonds, because you understand the risk. And when you look back at worst case scenarios, the worst case scenario for a 40-60 portfolio has been a loss in the 20 to 30% range. And that's a 1 year loss. A 5 year loss, been fractional, tiny. So if you're okay with that, it wouldn't be unreasonable to consider something like a 40-60 portfolio. But the 20-80, the reason it's set up as that is because for most people, 20%, that's a risk of, the 10 to max 20% range. And that's all most people can handle when it comes time to start taking withdrawals. So, but you're in the ballpark there. But no, I would not try to chase the right stock funds. That's a mistake. 855-935-TALK is our phone number, 855-935-8255. And you can call it 24 hours a day, 7 days a week. And before we go, let's do our words of the day. And today it's not just a word of the day, it's two words that go together. Long and short. So I'll give you the long and short of it as it refers to securities. I talked earlier about mutual funds that sell stocks short. Kind of confusing for most people because you get selling and you get buying, but what is selling short or buying long? Buying long means you actually buy the security. You hold the security, you're, quote, long the security. You have the security in your account, you have it in a safe, you have it in a drawer at your house. You are long the stock. You own the stock. That's the term. So all it means is you actually own it. If you're short the stock, you don't have the stock. I don't have any stock. I'm short the stock, but I want to sell it. Well, you can do that. It's called selling short, but you don't have the stock. How are you going to sell it? To sell short, you have to borrow the stock from somebody who has it long. And a lot of brokerage firms, well, almost all of them, have access to stocks from mutual funds or in their own portfolio that they own and that they're willing to lend to you, but you have to pay them interest on the loan for as long as that short sale remains uncovered. In other words, you didn't buy the stock back to pay it back. So if you're short, you don't own it. If you sell short, you're selling something you don't own. You have to borrow it to sell it. It's very simple. And selling short is something no one should do except a gambler, a speculator, or maybe somebody who runs a hedge fund. And even then, it often doesn't work. Thanks for being a part of this episode of the Talking Real Money Daily Podcast. I'm Don McDonald. Thanks for being there. We'll have another episode tomorrow. As a matter of fact, we may even have 2 episodes tomorrow, depending on how quickly the editors get done editing the weekend podcast. So you might get 2 tomorrow and 2 Wednesday, or 2 Wednesday and 2 Thursday. But either way, you get 7 podcasts a week from Talking Real Money. So tell everybody you know there is always great investing and money advice here all the time. And please go to iTunes, not iTunes. Well, actually, it is iTunes on computers or Apple Podcasts on an iOS device, and subscribe to the podcast so you always get it. And if you really like it, please leave a review. Thanks for listening. I'm Don McDonald.
Talking Real Money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.